We're going to now shift gears from defense and talk about SBI Card. We've got the top management with us, Rama Mohan Rao Amara, the MD and CEO of the company, right here with us. If you look at it, the stock is high by about 1.5% in trade, but what we're going to be talking about is the recent consumer spends that we've seen, the recently concluded festive season as well. Was it, in fact, the biggest ever or not? And with that, let's get straight down to it. Talk to us about the recent business that we have actually seen and the festive season. The NII's growth has been slower than expected. Give us a perspective. Why was that the case?
Which is a function of two factors. One is the kind of interest income growth, what we have seen, and the cost of funds. It's ultimately a combination of these two factors. Interest income is, of course, one part that has helped or where we have focused is increasing the share of EMI loans steadily. It almost improved by 6 percentage points over a period of time from a trajectory of 29%, 28% to 34, 35%. But of course, the revolver has been stagnant, which is typically in line with the industry. We have been taking a number of steps in terms of boosting the revolver, or creating or attracting a segment of customers like self-employed who have a better propensity to revolve. Of course, the 2% reduction in the revolver from 26 to 24% as of September is also the result of build-up in the transactor NEA end of September. More on account of a lot of festive spends we are able to garner in the last 10 days of September. That's the result. But if you normalize it, still the revolver has been a bit stagnant. Coming to the cost of funds, of course, cost of funds, we have been the beneficiary of a benign trend in the economy till a couple of quarters back. But now we started seeing a kind of increase in the cost of funds. In as much as 60 to 65% of the assets are funded through short term, where essentially they are bank lines linked to the external benchmarks. Whenever there is a revision in the external benchmark, then automatically we get the impact. So we have seen some impact. In fact, some more impact is likely to be felt in this quarter, October, November, December quarter. But we will have some opportunity to mitigate this impact through a kind of passing on or transmitting the rate increase through the disbursals, fresh disbursals that will happen. So we are calibrating our strategy very carefully, and while NIM compression is given under the current circumstances where the rate cycle is, a couple of more rate rises are likely, but still we are taking all the steps to partially mitigate the impact.
Right. You know, fee-based income for you has seen strong growth. Will the guideline in October then impact this number for you?
I think while our aggregate revenue over a 12-month period improved by 28%, fee income actually grew by 30%. In fact, interest income grew by 25%, but fee income maintained the robustness at 30%. While increased spends, what we have seen, we have seen improvement in the per card spends. It will be spend-based reversals of fees, so that way subscription fee will be slightly muted. But on a positive side, it also shows the engagement with the customers and the activity in the portfolio. So barring that, the rest of the fee lines are generally intact. But of course, going forward, from 1st of October onwards, a fee line called over the limit fee, that may get slightly impacted because now there is a requirement in terms of RBI guidelines to take explicit consent from the customer. So till the customer gets used to this process, there can be a small dip in the income, but we are confident of clawing back most of it, either through the OVL or through other measures. We are likely to mitigate the impact of it over a period of time. So overall, with the volumes being robust, new customer acquisition being robust, spends being robust, we don't see any issue with regard to the fee income.
Right. You know, the other piece impacting your profitability is higher provisioning as well. Where is it that you're seeing stress, in which part of your portfolio, and how is it that you see it shaping up forward?
Credit cost has increased from 5.6% in the June quarter to 6.2%. That way, definitely it's an increase by 60 basis points. But that is also largely on account of increase in the stage 1 assets. Particularly during the end of September, particularly last 10 days, we garnered a lot of festive spends. which is more like a transactor NEA has increased. Some part of it will eventually turn into EMI loans, some part of it may get reward, but a major portion of it will come back as the customers pay off. So there is a possibility of a kind of reversal in these provisions over a period of time. So this is more like a momentary. This happens with a kind of build-up in NEA whenever we see during the festive time. So it is the same seasonal trend what we have seen now. So largely we will be range bound because whenever, I can assure you we were well below the pre-COVID range of 6 to 6.5% under the normal circumstances. Our efforts are to keep it below that and also use the cushion available to experiment with new customer segments and improve the growth as well.
So we are nearly done with the festive season. How have the spending trends been versus last year?
The industry spends, if we see for the last 6 months, they crossed 1 trillion mark. And of course, the September month witnessed a kind of 1.22 lakh crores, which is a kind of a new benchmark. Largely on account of retail, while there is a bit of corporate play is also there. This indicates the strong revival in the consumer confidence. At SBI Cards, the volumes have grown. Our market share, particularly the exit market share for September, was at 19%, which is a significant improvement over the previous months. This was possible through a kind of launching right products and entering into right partnerships to give appropriate value to the customer. So these strategies have worked. And coming to the next couple of quarters, how the situation is going to be, well, it is a bit difficult, but at least for Q3, we are expecting the momentum to continue because the festive period is still continuing in October and some part of it will again come back in December. We are reasonably confident that Q3 will also have the same momentum what we have seen in Q2.
Okay, and separately, there has been this regulatory overhang for card players as well, right? Especially in SBI Card, we have seen that subdued returns have been there. What's your message? How should one read into these developments? And as an investor, how much weightage should we give really to these headwinds that we are talking about when it comes to regulatory environment?
In terms of the discussion paper released by RBI covering various payment instruments and payment modes, of which credit card is also one part, industry has submitted its feedback to RBI. So we are waiting for the next steps from RBI. But in the past as well, actually the credit card MDR was looked into. Credit card industry was able to present its case as to why it is unique. Particularly the credit risk is borne by the issuer, funding cost is borne by the issuer, rewards are also passed on as a benefit to the customer. So we argued in the past as to why it has to be given a different treatment as compared to a debit card. We have been successful in the past. So we are waiting for the next steps from RBI and a kind of consultation from RBI. But having said that, if at all, if there is any change in the reduction in the MDR, we do have levers in terms of free credit period or the reward cost. Both levers can be used in terms of managing the reduction, but it all depends upon how much reduction will be there.
Okay, so that's a word coming in from the management of SBI Card. The stock actually doing okay at the moment. Overall, though, it has seen subdued returns.